Good morning. Good morning. Good morning, everyone, and thank you very much for joining us. My name is Neil Sugu, and welcome to Maddox Teesdale for today's joint session with Lubbock Fine and Maddox on the hot topics for 2018 in strategic planning. We have four fantastic speakers. First, Martin Smith, partner of Maddox Teesdale, known to many of you. Martin is one of the country's leading lawyers on strategic land projects, including collaborations, options, promotion agreements, and development agreements. Then John Bosworth is also planning partner at Maddox Teesdale. He leads our planning practice, and throughout his career, John has advised on some of the largest regeneration schemes in London and in the south of England. John will be followed by David Maddox of Maddox Planning Consultants. David's background has been in several planning and architectural and surveying firms, and he specialises in planning advice on major applications, principally for developers and funds. And finally, Jaspal Dillon from Lubbock Fine Accountants. Jaspal's specialism is VAT, having started his career at Customs and Excise as a VAT inspector. So it's fortunate for us that he has sat on both sides of that table. Each of our speakers will present for about 10 minutes, which should leave us a few minutes towards the end for some Q&A. I'll take a seat now and hand over to Martin.
Morning. If there's anything more terrifying than doing public speaking anyway, it's A, having an esteemed colleague build you up in a way that you can't possibly live up to, and secondly, doing it in front of a room of people who actually know what I'm talking about, know better than me. So please be gentle and no heckling. As Neil said, we're sort of looking at what we call the hot topics in strategic land, and what I would like to do is just talk about the sort of themes that we are seeing in the traditional strategic land assembly documentation at the moment, just explore those in a little bit of depth. Here at MT, we have a client base in this sector that encompasses both promoters and developers and also landowners. So I think that enables us to kind of see things from both sides and see the arguments that come up on these issues. And I'll try and give you some insight into certainly what we're hearing from the marketplace at the moment. To begin then, really just to set the scene and clarify what exactly I'm going to be talking about, the current sort of very much the legal structure of the jure is the promotion agreement. It's a specialised form of contract for services under which the promoter takes on the risk of securing planning at its cost, provided certain criteria, usually around effective quality of planning and pricing, are met. The land is then sold in the open market. The promoter recoups its planning costs and is then paid a success fee, which is usually calculated as a percentage of the achieved sale price. These have grown in popularity over the last 15 to 20 years, not least because they undoubtedly achieve a far greater alignment between the promoter and the landowner over the key issues of maximisation of price and minimisation of planning costs. It isn't a 100% alignment. I'm not sure that could ever be achieved. The usual sort of percentage division between landowner and promoter will fall somewhere around 80-20, and that will always carry tensions in it as you get towards what defines a quality planning consent, and particularly the promoter's requirement to get out of the project as quickly as it can, frankly. But they definitely achieve a better alignment than the traditional model, which is, of course, the option, a form of conditional agreement to acquire land, conditional on the developer or promoter getting the planning consent. Again, the developer will assume the cost and risk of that process. And then it deviates fundamentally, of course, from the promotion agreement, because then the developer will itself acquire the land through a market value exercise at an agreed level of discount. And it's really in that market valuation exercise that the traditional tensions in this form of documentation appear. The landowner will, of course, be looking to argue for the highest possible market value, and the developer is, of course, looking to argue for the lowest possible market value. There are other inherent problems as well, because the developer is buying at market value, which will fully take account of Section 106, planning gain, etc. It is less sensitive to the need to minimise that cost, because effectively it's washing through in the price at which it can acquire. So those are the two forms of documentation traditionally used in this sector, and what I would like to do now is just run through some of the trends that we're seeing on both of them. There'll be a greater emphasis on promotion agreements just because by far the majority of the transactions that we handle utilise that form of documentation. But I will say some words about option agreements towards the end of the talk. So beginning then with what we're seeing with promotion agreements, and starting with the calculation of the promotion fee. The traditional model is what I've termed the exclusive model, which is that the promoter gets as a top slice the return of its planning costs, and then gets a percentage fee, as I said, calculated usually by reference to the sale price. On smaller schemes, we have seen a move towards an inclusive structure. So the promoter simply gets a fee, and that is inclusive of all its planning costs. That provides certainty of cost of a project for the landowner, and also takes out of the relationship some of the tensions that can flow from the landowner wanting to be assured that money is being spent in an economic and sensible way, which it has half an eye to if you're under the traditional exclusive model. On a similar theme, and again really tending towards the smaller scheme end of the market, we also see landowners pushing for planning costs and appeal costs to be capped, and again that is just to bring cost certainty for the landowner. And then look at the other end of the spectrum on larger schemes, we have begun to see the idea of stepped promotion fees. So the promoter might get a certain given percentage up to a certain level of overall sales receipt, and that would usually reflect sort of the expectations of both parties as to how the project is going to perform. And then if that actually sort of trips into super performance, there's a smaller level of returns to the promoter, but still obviously enough to incentivise it to try and get to that higher level of attainment. Continuing to focus then on the financial elements of the promotion agreement. Capture of existing use value. This is very much a current issue that we're seeing more and more. This is the basic idea that the landowner gets a top slice return out of the sales receipts before there is then any calculation of division between itself and the promoter. And the underlying idea of that is that it reflects the inherent land in the value, sitting in the land before the promoter actually starts to work on the project. And that inherent value can of course include some hope value. Usual methods of calculation for that are routinely a multiple of agricultural value, or an agreed fixed sum, which would then usually be calculated by reference to acreage, and we would look to index that as well to keep it tracking the true value of money. Our experience working for the other side of that equation is that this is something that promoters are usually happy to have a conversation about, obviously subject to agreeing the right level, and importantly, just watching the interaction with that level of receipt and the minimum price or minimum return that a landowner looks to impose on the transaction as a whole. It's important that the two elements are properly reflected. Turning then to the logistics of sale, and again, this is something that we are seeing more on the larger schemes, because it's a larger scheme issue. But that is a growing trend for landowners to have thought to the delivery of infrastructure when looking to appoint promoters / developers, and if possible, binding that party in to the actual process of delivery of infrastructure. The logic from the landowner's perspective of that is that it gives assurance that when the happy day is reached and planning is achieved, the actual delivery of phased sales, which is why I said it's more applicable to a larger scheme rather than a smaller scheme, can be delivered. It also can carry a benefit politically, which is that it can seek to address the deliverability issue that planners find focus on at the moment. And I know many of you in the room will be aware that there is a sort of a continuing kind of suspicion at central and some local government level of the sort of pure promoter function in land delivery. I think there is a perception that somehow promoters kind of sit in the middle in a way that interrupts the flow of delivery of housing units. Those of you who operate in that field will know that nothing could be further from the truth, but nonetheless, it is definitely a perception that sits within government and therefore within planning departments. The downside, of course, for the promoter developer is that it requires potentially enormous levels of financial commitment at a point where the true scale of that, the nature of that, the timing of that, and most importantly the cost of that are almost all unknown. The midpoint that we have structured on a number of transactions is to bind the promoter into procuring the delivery of the infrastructure in return for a predetermined development management fee, but leaving the actual funding of that process to be sorted on the market at the point in time. Minimum price. So this is the criterion that a landowner will look to build into the agreement, basically stating a level below which it is not obliged to sell the land. It's usually a level which is very much an extremis figure. It's not set at what the parties genuinely expect the land to achieve or anything like that, but it is it's almost like an anti-embarrassment figure. A very common problem that we find, particularly at heads of term stage with this, is that these are routinely discussed in terms of minimum price, whereas actually what the landowner really has in mind is a minimum receipt. How much will I get from each acre when it is sold? And the landowner's focus there, quite apart from ensuring that it doesn't sell the family asset at a too low a price, is also the need to make sure that from any given sale, it as a very minimum has enough to pay its tax bill. Calculation or application of the minimum price or the minimum receipt, usually done on either a gross or net developable acreage basis. Gross acreage basis simplifies the mathematics, but net developable more truly aligns it to the value that is created. And in either instance, certainly from the landowner's perspective, we should be thinking about indexation around those figures so that again they track the value of money. Before I leave promotion agreements, I just want to talk about two issues that are really very current in current thinking for both landlords, for landowners rather, and promoters. First is tax freezer. This is the landowner's ability to decline to sell land in an adverse capital gains tax climate. And obviously the underlying concern here is the reintroduction of something resembling development land tax. This is obviously a significant bar for promoters because this will, by definition, only apply at the point that the promoter has effectively done its job and secured the valuable planning consent. So the issues the promoter needs to be thinking about are at what level of taxation does that operate? We wouldn't really routinely see anything below a 50% tax rate and sometimes higher, so it really is looking to operate only in very penal tax environments. Secondly, there has to be a maximum period for which this freezer can operate, and routinely we see terms of sort of 5 or 7 years, and I think insofar as there is any logic to that, is probably to allow a rogue government to effectively come out of its term and for the sins of the fathers to be undone by the new regime. The promoter also needs to focus on whether the landowner gets one opportunity to do this or can do it on multiple occasions for a maximum period of freeze. And then, again, thinking about it from the promoter's perspective, the other really important thing is to watch that the critical timescales, so the term of the promotion agreement and any of the performance timescales that are written into that document all automatically extend by the amount of that freezer. Otherwise, you can find yourself in a very unhappy position where time is running out as a promoter and you're simply unable to do what you need to do. The second concern, really, for both sides of the equation at the moment is the risk of compulsory purchase. This is increasingly perceived in the marketplace, certainly from our experience, as a really apparent risk, particularly if we would find ourselves under a call with government. The questions that derive from the threat of CPO are, first of all, what is the promoter's entitlement to at very least recover its planning costs, its out-of-pocket expenditure? Secondly, the need for the landowner and promoter to cooperate through the CPO process. The promoter's own interest can be a qualifying interest for CPO purposes, and so that all needs to come into the mix as well. And then there is the question of what is the relationship between minimum pricing, value achieved on CPO, and recovery of some level of fee for the promoter. The sort of outcomes that we have seen on recent transactions. If land price on CPO is below minimum price, the promoter is entitled to recover its cost but gets no fee. As soon as CPO values trip above minimum price, question mark whether that would be the case, of course, in the project, then we begin to see a sliding scale of recovery of some level of promoter's fee for the promoter on that. Turning then to the sort of the old model, the options. As I said at the outset, 80% or more of the transactions that we see at the moment are promotion agreements, and I think that will continue for the foreseeable future. But we are seeing specialist use of options, particularly on more complicated and multi-landowner assembly transactions, where the involvement of late participants can throw up real complexities for those parties, both in terms of their ability to join existing collaboration and equalisation structures, or their willingness to do so. And we have seen options used as a way of bringing in critical pieces of land where landowners are unprepared or unable to join into wider equalisation. On schemes where land coming into promotion involves a private residence, an option provides one of the few ways that that landowner can continue to apply for principal private residence relief for CGT purposes. It's almost impossible to achieve under pooling trust equalisation structures, so again they have a particular application there. And if in a given collaboration you have smaller landowners who are much more sensitive about when their cash receipt comes out, again an option can afford a way for that individual's requirements to be met. In terms of option pricing, traditionally it would be a market valuation, of course. We are seeing more hybrid type solutions that achieve something close to equalisation of land value, with an initial payment, a reservation of some of that payment to allow for fluctuation, and then an end of project calculation with a payment back or a further payment to the landowner in order to achieve something resembling equalisation. It's imperfect, but it can get to something closer. It's very complicated to bring these into an existing collaboration equalisation structure because they have potentially quite significant impacts on cash flow and phasing. It is effectively accelerating receipt to one landowner, and that will always come at a cost to the other landowners, and it is also compelling the end developer to buy land potentially out of sequence, and that can have infrastructure and again cost of money cash flow consequences. And so if these structures are being brought in alongside existing collaborations, the financial model needs to be quite detailed to pick up those points. There's one final just sort of subset of documentation that I want to mention, which is sort of hybrid promotion option agreement. This is a basic promotion agreement structure, which then has stapled onto it the right for the promoter developer to itself acquire some of the land once planning is obtained. These, of course, are very much favoured by the house builders because it gives them product at the end of their land promotion function. The issue for landowners is the question of ensuring proper market pricing, making sure that we've actually tested the market with open market sales before then allowing the promoter developer to buy land itself. In order to achieve that, we routinely see a cap on how much land the promoter can acquire. A 50-50 split is a very common way of resolving those things. And then other points that all the parties need to think about are what the plot sizes are, the identification of the plots, how you select which the promoter is entitled to buy and which are going to the open market. A sort of you cut the cake and I choose the half approach is quite a common one. So the promoter will work, having been planning, to divide the site up into black and white phases, and the landowner then selects which of those phases the promoter is entitled to acquire. Question of delivery of the gateway plots. It can be very attractive for a landowner who has signed up with a quality house builder to have the reassurance that that quality house builder will kickstart development. From the house builder's perspective, signing up to being compelled to buy any land and or develop it out, that can be a very difficult thing to get board clearance on. Often we see the resi developer end up with the right but not the compulsion to buy land, and that then has to be carefully thought through in terms of the marketing strategy, because if that sits as a preemption, there is the risk that dilutes interest or negatively, in another way, negatively affects interest on the marketing process. It is basically a dog in the manger who can or cannot elect to buy land. So quite complex issues that roll out of these. I have to say, if we're advising landowners, we don't set against these. If we're advising house builders, they are, of course, the sum of all parts. So in summary, promotion agreements are still very much preferred, particularly, I think, by landowners. The division of sales receipts is something that we're seeing evolving to better fit individual projects. There's definitely an enhanced use of options to address particular issues arising out of large-scale assembly. A very real fear of development land tax or similar coming down the line. There's all sorts of concerning utterances by both sides of government at the moment that would point to something of that nature and the impact on land values, and an equally real fear of CPO. And anecdotally at the moment we are seeing the HCA or Homes England, as they now are, generally adopting a much more interventionist approach to kick-starting large-scale projects and installing. And I think for all of us in the sector, that's a real wake-up call. That's something we need to be aware of. Right, I'm going to hand over to John, who's going to take you through some planning for this.
Thanks, Martin. Martin said there's a little worse than speaking when you've been picked up in a way that you can't possibly live up to, and you're in front of a room full of people who know more than you're talking about. If I could just add two more things in terms of there's nothing worse than realising that your penultimate slides have been completely messed up, as you'll see later, and being asked to perch on one of these three little stools here. So we've avoided the stalls, and hopefully I want to deal with the glitch and the gremlin in the slides. So this is just, I'm going to talk about green belts. So we thought, what can we talk about from a planning point of view that sort of is topical and strategic and so on, and this is what we settled on. So rumblings. There's always rumblings about green belts. The profession seems to hate them, the politicians seems to love them. So there's that constant tension, and where we are today is really no different. I just highlighted a few sort of things of change or movers for change. The Planning Officers Society a couple of years ago now published some quite helpful guidance for local authorities who are thinking about changing their green belts, and effectively, when I talk about change, I mean reducing them to enable development to take place on them. The LSE did quite a good study on London, recommending that that's precisely also what should happen. They drew attention in their study that in London, 42% of the green belt is neither parkland, environmentally important land, or even publicly accessible, and yet of that 42% is also within 2 kilometres of a tube or railway station. So big potentially in London for greenbelt land to offer a sustainable solution. Housing White Paper this time last year, everybody got a bit excited that it was going to make some major announcements. It didn't really indicate that. We're now waiting to see what comes out of it, but a few tweaks to the National Policy Planning Framework were suggested as to when local authorities might go about reviewing greenbelt. So something, when we eventually see the outcome of the White Paper. And then just last November, the National Infrastructure Commission, before Lord Adonis, through his toys out of the pram, produced an interim report. One of its recommendations, it's not even meant to be looking at housing, but they couldn't help it. And one of the recommendations of the in their interim report is potentially developing around infrastructure hubs in the Greenbelt. So we've got all those sort of noises going on, and then in a sort of just a bit of London context on the Greenbelt. So 35% of the London boroughs comprise Greenbelt. Obviously, that's basically the ones around the edge that have the lion's share of all that. A sort of similar study to the LSE study, the Centre for Studies, said just by giving up 2% of Greenbelt in London, you could provide 430,000 homes within 2 kilometres of a railway station, so similar sort of issues. We've seen people having a go at these nibbles, so there's a Red Road with the Jockey Club applying to build 3,000 homes at Kempton Park. That's or making promoting that through the local plan, so people are having a go at it. But then the draft London plan, which was published end of last year, the politicians not really having much of it, particularly the mayor. He's looking to safeguard both metropolitan land and Greenbelt, notwithstanding very ambitious housing targets for the capital. So that's a sort of bit of London context. Now, I've set out a lot of the national planning policy framework in these next few slides, just to give you a reminder. But basically, here, the purpose of the Greenbelt to protect urban sprawl, to prevent urban sprawl, and one of the key things about Greenbelt is meant to be there permanent, so can't be tinkered with too often. And then I'll set out the purposes of the Greenbelt there. So there are 2 ways really, of trying to develop in the Greenbelt. One is going through the statutory plan process and getting the boundaries revised. The other is perhaps a little more speculatively on a planning application, if you can seek to come up to. The guidance, national guidance here, is that a boundary should only be altered in exceptional circumstances. So that's the key test. What is exceptional circumstances? And I'll look at how the courts have looked at that in a second or two. This is what you can do in the Greenbelt. So basically, inappropriate development is not allowed in the Greenbelt, and those are the list of inappropriate developments, more or less defined by if it's not in that long list of things, it's inappropriate. So I won't go through that list, but that's the way it works. So those are appropriate, anything else inappropriate. And again, similar to revising the boundaries in exceptional circumstances, you can only have inappropriate development in the Greenbelt in very special circumstances. So those are the 2 very similar tests, either very special circumstances or exceptional circumstances. There's a bit of extra guidance here in paragraph 88. Very special circumstances only exist when it's very clear that, on the one hand, that need for the development clearly is outweighing the protection afforded by the Greenbelt. So it has to be very clear in terms of that planning balance. So, just 2 cases, this is where the glitch you'll soon see comes up, in how these 2 tests have been applied or in practice and then looked at by the courts. Calverton was a case in Nottinghamshire where 3 authorities, Nottingham, Gedling and another one whose name I can't remember, had joined together to produce a strategy to jointly review the Greenbelt around Nottingham, and in order to deliver 30,000 new homes. went to a local plan review. The inspector looked at the need to deliver that amount of housing, looked at the circumstances, and came to a view, basically agreeing with the authorities, that in order to deliver that amount of homes, something had to give, and therefore she endorsed the policy in the local plan that the green belt boundary should be reviewed. This was a two-stage process here. They didn't actually propose specific reviews to the green belt. They were looking at, is it acceptable in principle? Once that policy got through, there was then going to need to be a sort of second local plan process that actually implemented, looking at where bits of green belt were vulnerable, and it proposed basically what planners call a sequential test to releasing the green belt, looking at basically finding land for housing and releasing green belt basically being the last option in a list of trying to find a site. So that was the strategy of the plan. This two-stage process, justified because of the housing need, but let's say the green belt release being the bottom of the list. So that was challenged by a number of parish councils, saying, well, basically they were trying to say, you've simply said housing need is the issue. That can't simply be exceptional circumstances on its own. There's got to be more to it than that. That was the thrust of their challenge, and the court, well, disagreed that that was the way that it actually had been gone about. Certainly, the court said housing need itself is not sufficient to be an exceptional circumstance. So just because there's a shortfall, that may well often be the case. And if you're in a heavily constrained area by green belts, other protections, that's not necessarily going to be surprising. But but it is the first sort of hurdle. Once you've gone past that, it's incumbent on the authority to look at all the measures in the round before they can conclude there are exceptional circumstances. So, what other restraints are there in the area? What are the consequences for achieving sustainable development in the area if you don't go through this process? What actually harm might arise to the green belt in this particular area, and how might you sort of mitigate some of the impacts from revising the green belt? So the court said in this case the inspector had done enough in terms of that analysis, that broader analysis beyond simply the housing need issue, to justify her decision and her endorsement. So in this case, the process was upheld. So I skipped over that one. So that was exceptional circumstances and promoting a revision to the boundary. On the other side, very special circumstances on perhaps a more speculative application. Hunston is a case in St Albans. St Albans not always known for its preparedness to see housing development in the area. So this was for 100 odd houses in the green belt. No up-to-date plan. It was hopelessly out of date, I think, in St Albans. 20 years out of date or so. So there was a sort of planning vacuum. Disagreement as to what housing figures the council should be looking at. What the inspector did was, in this case, was look at the out-of-date plan and the work which had been done following that, and came up with a housing figure, but it was half what anybody else had come up with. And as a result of that, she said, well, actually, the council can provide enough housing, no special circumstances, no need to release land in the green belt. But that was challenged, and the fundamental success of the challenge was the inspector's mistake of relying on an out-of-date, revoked plan to come up with the amount of housing that should be provided in St Albans. So that was the basis on which the whole decision was quashed. and the court went on to again to say simply a shortfall in housing isn't going to be enough to amount to very special circumstances on a planning appeal, on a planning application. What should you do? This one I need to go back. This isn't Colton, so this is still Huntston. So is there a shortfall? Yes. But then again, look at the issues that are there in the round, the amount of shortfall, the scale of shortfall in terms of that 5-year housing land supply. Look at the context of the shortfall in the area. Again, look at the constraints in the district. Is it a lot of green belts, or is it are there other opportunities? As I said, there's nothing particularly special in itself about the shortfall where all the area is green belt. So that in itself won't be enough. So you need to go beyond looking at just the shortfall and trying to, so I say, really pin it down to why it's exceptional circumstances, very special circumstances in this case. So ultimately, that's going to be a matter of planning judgment, and the courts will only interfere, I think, if an inspector or a local authority hasn't gone through that sufficiently robust planning process. So there is no special way of doing it, but providing you can persuade a decision maker to go through it and look at it properly and in that rounded way, then you should be successful in having a decision which will stand scrutiny. Just lastly, because it's good to have a kick at an authority when they're down, another one on a recent decision in St Albans. This didn't go to the High Court, but it's a case where they lost on an appeal, again in the Greenbelt, 300 odd dwellings in the Greenbelt here. But this was within the grounds of an FE college, Oaklands College, FE college, and had a fair bit of surplus land in a way. It was the reason for the planning application was basically an enabling development to help the college to sort of get back up on its feet and to replace a lot of very substandard buildings. And here the argument was put to the inspector that the only way of funding the college was the residential development that was going on. There was no other funding available. The council came up with no other schemes which would help the college. It was an area still where there was less than a 4-year housing land supply. And the inspector and the Secretary of State, because it was a calling decision, looked at this, agreed that the harm to the Greenbelt was clearly outweighed, so that test in the FPPF of clear harm being clear evidence that the harm was outweighed, and as I say, as a result, very special circumstances were found and planning permission was granted. So that was a little sort of cameo. I'm going to hand over now to David to carry on.
Thanks, John. Today I'd like to just talk about, in the main, taking a staged approach to seeking out high opportunity areas in planning terms for strategic growth and how we currently help clients promote land through development plans. Before we start there, I'd like to just talk a little bit about our own credentials. We do a lot of strategic land promotion at all stages of the planning process, from 3,600 homes up in Kings Lynn, where we've got an allocation and we're now taking that through planning applications, to doing Greenbelt review evidence-based work up in the Wirral, and also everything in between, also local planning examination at West Hatfield. As a bit of background, you're probably all aware that the government has said that the housing market in this country is dysfunctional, and the root cause for this is that for too long we just basically haven't built enough homes. The government's 2015 commitment in the Housing White Paper is to deliver 1 million new homes by 2020, and to supply a further 500,000 by 2022. The government aims to publish a revised National Planning Policy Framework in the spring of this year. The government's Housing White Paper set out 4 main areas where action is needed, which were planning for homes in the right places, building homes faster, diversifying the market, and helping people now. For strategic land promotion, we have focused on planning for the right homes in the right places, and the government consulted on its proposals in this area in September 2017. In this consultation, the government set out its proposed approach on, amongst other matters, calculating local housing need and statements of common ground. On calculating local housing need, the government wants to simplify the process by standardising it. The proposed approach consists of 3 components. The starting point should continue to be a demographic baseline, which is then modified to take account of market signals, for example, the price of homes. However, the government also recognises that it is important to ensure that the proposed housing need is as deliverable as possible, so it proposes a cap to limit any increase an authority may face when it reviews its plan. Where plans are more than 5 years old, if new plans have not been submitted to the Secretary of State by the 31st of March of this year, although it is now looking like it's going to be the summer of this year, or before the revised National Planning Policy Framework is published, whichever is the later, the standardised methodology of calculating local housing need will be used immediately. If a local plan, though, is currently at examination on or before the 31st of March, or when the National Policy Planning Framework is issued, again, this might be more like the summer now, then the plan should continue to be examined and rely on evidence prepared using the current method. If a plan is withdrawn from examination or found unsound, the local planning authority should prepare a new plan based on a new standardised method. On statements of common ground, the evidence from recent local planning examinations suggests that failing the duty to cooperate is one of the most regular reasons why plans are not found sound by the planning inspector. The government has identified 3 main problems with the duty to cooperate, being first the lack of transparency in early stages of plan making about how local authorities will work together. Cooperation is only tested towards the end of the plan making process, and authorities are not legally required to reach an agreement on the issues. The government therefore proposes that every local planning authority produce a statement of common ground over the housing market area or other agreed geographical area to set the cross-boundary matters, including the housing need for the area, the distribution and proposals for meeting any shortfalls. In setting out the strategic cost boundary issues, the statement will record where agreement has or has not been reached. To identify planning hotspots for strategic land opportunities, we create maps of each English region that show 3 key data fields. Firstly, whether the local planning authority has a surplus or shortfall against its indicative assessment of housing need based on the proposed standardised formula from its current local assessment of housing need. Secondly, the proportion of a local authority area that is covered by greenbelt, national parks, areas of outstanding natural beauty, or sites of special scientific interest, notably the environmental designations or other policy constraints that ordinarily prevent local planning authorities from meeting housing need. And thirdly, and perhaps most importantly, the stage of preparation the local planning authority, the local planning authority's local plan is at, such that there are greater opportunities for strategic land promotion when a plan is at its early stage in its preparation. So we currently maintain data of all local planning authorities in England on whether its local assessment of housing need is above or below the government's proposed standardised formula. We also hold data of all local authorities on the proportion of land within their area covered by key environmental designations or other policy constraints, and the stage of every local plan. This information is contained on a database that can be separated into regions or any geographic area. On this database, I've extracted the data of all local authorities within the East of England. As you can see, you can search for an authority by name, see what its currently locally assessed need is, and compare that against the government standardised formula to ascertain whether that local authority has a shortfall or surplus. The database also shows the proportion of land that is within an environmental that is covered by key environmental designations and other policy constraints. And the database also shows the stage that the local authority's plan is at. Behind the scenes, this database scores each field so that the areas that have significant local housing shortfall against government calculations, i.e. they need to find more land for housing, and those that have a relatively low proportion of land constrained by environmental and policy designations, i.e. they can find more land for housing relatively easily, and those that are at an early stage of plan making, i.e. they would be most receptive to approaching land promoters, are given a high score, and they are called high opportunity areas. And those areas where all the converse is true would be low opportunity areas. This is taken again from the extract of the East of England database, and the scoring is then mapped, and it enables a quick and accessible way of identifying those high and low opportunity areas. So for example, this is the East of England, and you'll see from this map that the high opportunity areas at the current time include Bedford, Central Bedfordshire, Luton, South Norfolk and Norwich. For example, Central Bedfordshire is currently consulting on its Regulation 19 plan until the 22nd of February. And the government's standardised methodology for calculating housing need would see a 60% increase in the number of homes that would need to be built in that area. In addition to this, the area is relatively unconstrained, with only 40% of its land covered by restrictive environmental and policy designations. This map shows the growth locations allocated in the Central Bedfordshire Plan, which include a new village to the east of Biggleswade, creating up to four new villages in Marston Mortain, new extensions to the north of Luton and east of Arsley, and small to medium growth in existing towns and villages. With this information, we then assess for clients all the sites that are currently being promoted for development in the selected area, whether there are any identified areas of search in the draft local plan that are not being promoted, and whether we think that alternative locations should be selected. I hope you found that helpful on a stage approach.
Thanks, Lee. Okay, right, so my name's Jazz Dillon. I'm a senior tax manager specialising in VAT at Lubbock. For those of you who don't know who Lubbock are, we're a CFO of chartered accountants and also tax advisors. I'm just going to run through a couple of scenarios that we've experienced with regards to strategic land and some of the VAT implications coming out of that. So, scenario one is pretty straightforward. You've got a property developer who has the resource and expertise to develop the land, and you have a landowner. And essentially, the property developer provides his services to the landowner, which the landowner pays for. The payment can be a percentage of the uplift in the value of the land, or just the property developer's costs plus. So some of the issues coming out of scenario one, the first one is the tax point, and that being when the VAT becomes due to be paid and accounted for to HMRC. It's usually when an invoice is raised or the cash is received. However, if neither happens, it's generally going to be when the work's completed. However, a couple of things to be look out for in the construction industry. There are some special rules where the customer, i.e. the landowner, holds back part of the payment while any faults are dealt with, i.e. snagging, etc., etc. So in this case, when in the construction industry, it generally isn't the completion of the work, it is when a payment is received or a invoice is raised that the VAT becomes due. However, there are some anti-avoidance rules to be aware of where the landowner and the property developer, the property developer and the landowner are connected, because otherwise you could delay the VAT liability becoming payable. So the other thing to be aware of with the scenario one is the VAT liability of the property developer services. So for example, the zero rate applies to the construction of new dwellings, a new charitable building, or a relevant residential building such as a care home or student accommodation. The VAT zero rate also applies to the conversion of a non-residential building to a residential building. That's a conversion, but it applies to the supply of that building from a non-residential to a residential, not the construction services. So you usually have to put a structure in place in order to recover the VAT on those costs. You also have the reduced rate, which is the 5% rate, which applies to property conversions. This is the construction services. For example, turning a care home or a student accommodation into individual dwellings, or vice versa. So scenario 2 is slightly more complicated. This is something we typically see in a developer agreement scenario. So the landowner doesn't actually pay for the services. Instead, he supplies land in exchange for the construction services. So what we need to consider here is basically who is supplying what to who, and it basically goes down to the basic principles of VAT and supply and consideration. The property developer, he's providing construction services, and in our example, is also paying cash to the landowner. The landowner, in return, as I said, just provides part of the land. So now, for VAT purposes, we have two suppliers. One by the property developer of the construction services, going back to the various VAT liabilities you can have in relation to that. And even though he's not receiving any physical cash, he will still need to raise a VAT-only invoice if his services are subject to VAT. And on the other hand, you've got the landowner supplying part of the land. Again, he's not paying any cash, but he's actually supplying land, and he's making a supply of land in exchange for the construction services. Now, when you supply land, as a basic rule, it's VAT exempt, so he won't have to account for VAT unless it's a commercial property that's been opted to tax. The option to tax is when you bring the commercial property into the VAT system, and then every supply you make of the land is then subject to VAT. The reason people do that is because then the landowner can get that recovery on his costs, and if the person he's supplying the land to is able to recover that on their costs, then the VAT just flows through, and it's actually advantageous for the landowner to opt to tax. And again, he might need to issue a VAT-only invoice if the supply of the land is subject to VAT. So some of the issues coming out of this, where the property developers paid cash over, that's pretty straightforward, because that would depend on the VAT liability of the land. The construction services, which are supplied in exchange for the land, need to be valued, and the value is usually going to be, the value of the construction services will be the value of the land, because that's what's being paid in exchange for the services. Again, it then follows that the VAT liability, sorry, I'm jumping around here, again, it follows that the VAT liability of the construction services needs to be determined. Is it zero rated, reduced rated, or or standard rated. Again, that all depends upon what's being constructed and for who and what's going to ultimately be done with that land. So just some current things that are going on in VAT at the moment, and some hot topics with regards to land. There was a case called Bauhausi Holdings. Bauhausi had a relevant residential property built for them, which was a care home, and they financed the construction of the care home by the sale and leaseback. What actually happened was because they disposed of the land via the sale and leaseback, they had to repay all the VAT that was recovered on the construction of the property. So that's just something to be aware of with regards to how you finance and construct a construction could lead to a VAT clawback and loss if all areas are considered. Another case was the Iberdrola case. This is where the Advocate General in the ECJ said that this was in relation to Section 106 planning gain agreements, where Iberdrola supplied some services to a third party, not the people that they were constructing the land for. And as a result, the ECJ was saying that potentially the VAT was recoverable where the services had been supplied to a third party. But the ECJ actually disagreed with the Advocate General on that, so we were quite relieved about that, because it could have meant that where you've got Section 106 planning gain agreements, that you would be unable to recover the VAT on those costs because you're not actually making a supply to the person who receives those services. And also, just before Christmas, HMRC released Business Brief 0717. When you construct a new property from scratch, that is what you need in order to get the zero rating of the construction services and the supply of the land. But the new building is unable to retain any parts of a previous building, and due to recent case law, HMRC have now introduced a concept of de minimis with regards to the construction of new property. So if you have retained part of a previous property when constructing land, then constructing new build properties, if it only retains a small part of that land, then you are still able to get the zero rate reliefs.
Good. Thank you, Martin. Thank you, John. David, Gaz. Conscious of time, got any questions for any or all of our speakers today? Well, I might just ask one, and then we'll wrap it up. Probably for John, David, just in terms of how realistic you think it is that Greenbelt is going to be significantly altered in terms of its approach and government.
I don't think significant. I think there are opportunities. If taking the lead from the National Infrastructure Commission, I think in places where it's particularly sustainably located, I think that the fact that there's a station, there's capacity, and the fact that there could well be money flowing into the public coffers and possibly a clawback also for it, I think those opportunities are going to exist. But apart from that, I reckon it's potluck. But that's the one area where I think we realistically will see some changes.
I need to say that I think through the development plan process, there are very good opportunities to argue for exceptional circumstances for releasing that from
Even as it stands. Anything else from anyone else? Okay, well, in that case, thank you all very much. Welcome to join us next door for a bit of tea or coffee, maybe some leftover croissants.